Good evening. We're the University of Waterloo team, and today we'll be presenting our buy recommendation on Canadian Tire Corporation, or CTC for short. We'll be going over the business's foundation, growth potential, and focus on profitability, and then wrapping up with the investment risks. We have a $150 price target, representing a 15% return from Friday's close. CTC was founded in 1922 by the Bills family, who now maintain voting control. Until 2002, they consisted of retail stores, gas bars, and their credit card issuing subsidiary, CT Financial Services. In 2002, they made the acquisition of Marks, a specialty clothing retailer. Then, for the next 10 years, they focused on solidifying their foundation, growing from 900 stores to 1,100. In 2011, CTC made their second major acquisition, FGL Sports. FGL represented a unique opportunity, allowing CTC to acquire a national network of stores in a new retail subsector, sporting goods. Then, in 2013, they launched the IPO of CT REIT, which contains 70% of their real estate portfolio. Since 2002, they've gone from being a general merchandise retailer to a complementary group of consumer companies. CTC is split into three operating divisions: retail, which drives revenue, and CT REIT and CT Financial Services, which drive profitability. For these reasons, we view CTR, the largest banner by revenue, as the foundation, FGL, the fastest growing banner by revenue, as the growth, and Marks, CT REIT, and CT Financial Services as the profitability of Canadian Tire.
CT Retail is the largest retail banner by revenue and store count and competes in the general merchandise retail subsector with 498 locations nationwide. Their product offerings can largely be described as automotive services, fixing, living, playing, and seasonal. Through our analysis, we have found that CTR has consistently higher sales per square foot than the subsector average. We believe the drivers behind this performance are threefold, the first of which being the associate dealer agreement, in which dealers act as localized store owners and managers involving equity requirements. We believe this helps to align the economic interests of the corporation and the dealers, driving sales volume. CTR is alone among their competitors in offering this business model. We believe CTR's competitive advantage is due to its combination of convenience and affordability. We conducted a pricing analysis based on a basket of goods found across its retail competitors and found that in a price-weighted analysis, CTR ranks first among sampled retailers. In an equal-weighted analysis, CTR ranks second, also that CTR offers a price match guarantee. We then designed an algorithm to scrape the internet for mapping of all CTR locations nationwide and found that 89% of Canadians are within a 15-minute driving distance of a CTR location, beating its retail competitors. We believe CTR's competitive advantage is due to this combination of convenience and affordability. We valued CTC, the corporation, via a sum-of-the-parts approach and valued CTR via an unlevered DCF model. Based off projections for same-store sales growth and store growth count, we projected 3% revenue CAGR over the 5-year forecast period for CTR. This, combined with a terminal growth rate of 2%, gave us a valuation of $41, representing roughly 27% of the total target price per share.
Next, we'll be discussing FGL Sports, CTC's fastest growing segment. FGL boasts 433 stores across Canada, competing in the sporting goods industry under various banners. In our opinion, FGL's target consumers value two main things: selection and pricing, which go hand in hand. We believe FGL is a standout business because it operates both specialty and big box banners, bringing an unparalleled selection of products to the market. We conducted a price basket analysis and found that FGL's banners offer their products at competitive prices, with their major banners offering price match guarantees. Over the past year, FGL has embraced a digital strategy, which has attracted even more customers into its stores. We did a deep dive into the industry and found that there is a clear trend of non-chain stores losing market share, and that stores with revenue south of $5 million a year are largely unprofitable. This leads us to believe that FGL's large chain stores will continue to gain market share. We valued FGL using the unlevered DCF methodology. Based on management guidance and historical results, we have forecasted 44 net new stores over the next 5 years and a revenue CAGR of 6.3% over this same period. This, combined with a terminal multiple of 9 times EBITDA, led to a $17 per share valuation, representing approximately 11% of the total target price. Next, we'll be discussing CTC's focus on profitability, starting off with Marks. Marks is a clothing retailer with 380 stores coast to coast with a specialization on workwear. Through its product offering, Marks caters primarily to individuals working in goods-producing sectors, representing 44% of working Canadian men. We visited various stores that sell workwear and assessed the product offering of each store. Ultimately, we found that Marks' competitive advantage is driven by its focus on product differentiation. We view Marks as an integral constituent of CTC's focus on profitability, as it operates within the retail subsector that yields the highest gross margins at 54%. Given the weakness in commodity prices and the negative impact this has had on the demand for Marks products, we believe it will be CTC's slowest growing segment at a 5-year revenue CAGR of 2%. Ultimately, we valued Marks at $10 per share, representing approximately 6% of the total target price.
This brings us to CT Financial Services. CT Financial Services is strategically important for two main reasons. The first is its role in reinforcing the retail business. Through its credit card portfolio, it offers rewards integrated with its loyalty program to drive customer retention. The second is its ability to leverage the retail foundation to capture high credit card margin. This is shown through it contributing 8% of revenue and 38% of earnings. Further, its performance over the past 5 years has been an important driver of increasing corporate-level profit margins. We view CT Financial Services as a differentiator, with it contributing to CTC having the second highest EBITDA and net income margins of public Canadian retailers. To arrive at its valuation, we use the acquisition multiple approach. This approach values a business by the multiple that was paid for it. Thus, the multiple we're using is what Scotiabank paid to acquire a 20% stake in 2014. Using this multiple and its most recent earnings, CT Financial Services is valued at $32 per share, representing 22% of the total target price. And with this, we move on to the final component of profitability, CT REIT. Prior to its IPO, its properties were accounted for in the retail division. And through the IPO, we believe that there are two main benefits. The first is a benefit to shareholders. Through the REIT structure, it offers more reliable and tax-efficient distributions than the traditional corporate shareholder structure. And the second is greater financial transparency. This, in turn, unlocked the value of its real estate portfolio, and one major implication of this is a lower cost of debt. This past summer, CT REIT issued its first non-intercompany debt, illustrating its ability to issue debt at a lower cost than CTC, its parent. Thus, we believe that CT REIT enables CTC to optimize its capital structure through future refinancings. To arrive at its valuation, we use the trading multiples approach. Here we analyze public comparable Canadian retail REITs, and using the median FFO multiple of this peer set, we arrived at a valuation of $33 per share, representing 23% of the total target price.
To recap, we valued the foundation, the growth, and the profitability, and have two small parts remaining. The first is Gas Plus, which we valued using an unlevered DCF methodology, and arrived at a valuation just short of $5 per share. And the final segment is cash, accounting for 8% of our total valuation. In total, with a 28% discount to the voting shares, this represents our $150 target price. After finishing our valuation, we ran a Monte Carlo simulation with 100,000 trials and found that 62% of the trials yielded a return that was greater than the cost of equity.
Finally, we'll discuss CTC's key investment risks. To better understand the threat of these risks, we plotted them on a matrix by likelihood and impact, 3 of which we've identified as most significant and we'll now discuss in detail. The oil and gas industry has seen 2 years of downward pressure on commodity prices. We believe this results in layoffs, wage cuts, and discontinued capital investments. For CTC, this ultimately has the potential to decrease property value, increase bad debt, and decrease revenue. To quantify this, we ran a scenario analysis using 3 key assumptions: decreasing revenue in the next 3 years by 30% for Marks, 20% for CTR, and 10% for FGL, increasing CT Financial Services net write-off rate, and decreasing the multiple associated with Alberta-based properties. Together, this results in a share price of $137. The next major risk we identified was the devaluation of the CAD relative to USD. Approximately 40% of CTC's products are sourced in USD, and while management has indicated these costs can be passed on to consumers, we quantified the impact if they ultimately had to absorb these costs. Our scenario analysis for the continued devaluation of the CAD at 1.4 for 2- and 4-year durations yielded share price discounts of $19 and $28 respectively. The final risk we identified was Lowe's recent acquisition of Rona, but we believe this risk is significantly mitigated by the fact that CTC still outcompetes in terms of both pricing and geographic convenience. To recap, CTC is a group of highly complementary consumer businesses with a current focus on growth and profitability while leveraging its retail foundation. Alongside a fundamental undervaluation, we'd like to reiterate our buy recommendation with a 15% total return. We'd now like to open up the floor to questions, and thank you for your time.
What does the DCF imply in terms of either a price to earnings or EV to EBITDA for the tire business?
So for an EV to EBITDA multiple, the retail DCF implies a 7 times multiple.
For the last couple of years, CapEx is doubled depreciation. What's going on in the business requiring that much capital? How do you guys look at maintenance CapEx, and is that going to slow here at some point?
So historically speaking, for the past couple of years, it's been between about $400 and $600 million. So in recent years, the biggest run-up we've seen in the CapEx is as a result of increased IT spending. So we've incorporated that in our model going forward. So the guidance that management has provided is around the higher end of the $600 million range.
Overall, the return on capital, the management team, I think, is targeting 10%, but they've been doing that for a very long time and they've never hit it. Why does the return stink?
I would say that the management's focused on improving profitability, and we found that even their long-term incentive plan is based on their ability to drive earnings. Ultimately, at the end of the day, they operate in a very difficult sector to drive margins. Retail is very, very difficult to achieve higher margins. So instead, what we've seen is them grow CT Financial Services and really capture margins through that front. We hope to continue to see them aspire to achieve higher profitability targets going forward.
Follow on to that question, if the business has a hard time growing margins, you've got a 15% growth target in the stock price this year. Where's that going to come from? Multiple expansion?
Yeah, I can talk to that. So, from our analysis, after looking at how the market thinks about the equity, research equity analysts and us, we have a similar valuation methodology for the REIT and for CT Financial Services. The real undervaluation comes in the valuation of the retail division. So given current market prices, analysts' view, and our view as well, is that the market values the retail division about a 4 times EBITDA multiple. So that's where the difference in valuation really comes in, really in the retail division. So we think going forward, one way to close this gap in valuation is for continued outperformance by FGL. If FGL continues to deliver on growth and exceed expectations, we hope that this will drive a re-rating of the stock and enable that multiple lift on the retail division that is currently experiencing compression.
So do you have a normalized PE multiple then?
For overall the company or for the...
overall the company.
Currently trades around 15 times. I think if we saw a lift, can we go to the Canadian retail competitors? I think if we saw a lift in the price to earnings, we'd come up higher around 18 times.
For the FGL sports segment, it's quite interesting that when I'm looking at your slide, it shows that the net store closed for the year of 2012 to 15 of 62 stores. And the CAGR of the revenue growth is 9.4%, whereas in the year of 2000, or in your forecast of 2015 to 2020, the CAGR is lower, but with new store opening. So what is happening? Could you elaborate a bit on that?
Absolutely. So the sporting goods industry in Canada is fairly fragmented. We spoke a little bit about how non-chain stores are losing market share and smaller stores are losing market share and are largely unprofitable as well. So what FGL is doing is it's looking at this and they're seeing this as an opportunity to consolidate stores, and that's precisely what they're doing. So they're experiencing both, growth in market share through consolidation and same-store sales growth by improving the in-store shopping experience.
In your investment risks, you highlighted further expansion of CTR as a risk. When you look at your forecast, you are looking at future growth of the stores as one of the growth areas. Is that a contradiction?
Yeah, so I think that in general what we're seeing is because their store footprint targets or reaches already 89% of Canadians, we view potentially a mass expansion of next CTR stores to be difficult going forward. And historically, they've been growing at 1 or 2 stores per year, and that's what we're projecting going forward. In the valuation in total, new stores account for about 1% of revenue in total So it's not at all a significant part of the valuation, but rather consistent with how they performed historically.
Yeah, largely we believe CTR has reached a terminal. Largely we believe CTR has reached a terminal growth phase, and a lot of the growth will come from other segments such as FGL Sports, which we discussed.
So Mark's last year had decline in same-store sales. Now you've got a big investment in sporting goods. I think with any retailer these days, you have to ask the question, how does this business survive e-commerce and the Amazons of the world?
Sure. So we looked at e-commerce and how Canadian Tire Corporation is tapping into this, and they actually have laid out an e-commerce plan for all of their retail segments, including CT Retail, Marks, and FGL Sports. We can show you a basic look at some of the analysis we did for Canadian Tire Corporation, and we actually completed a purchase on the Canadian Tire website and looked at their peers as well to see how robust the experience was. Ultimately, we found that the Canadian Tire shopping experience was at the top. And we did the same for their app as well, and we found that that was very strong as well.
So in addition to performing the qualitative analysis Anand just discussed, we performed a quantitative analysis on their website. So as you note, on the top left and the top right are the key figures. So in terms of the average time spent on the site, consumers tend to spend longer, meaning they're spending more time buying goods. And in addition to this, the most important one is the bounce rate. So this is a rate that indicates if I go to the site, how many people actually end up leaving right away. So CTC has a significantly lower bounce rate relative to peers, indicating its current strength in e-commerce.
How comfortable should we feel about owning non-voting shares with this family? If you look at the transactions that they've done over time, have they been good investments? And since they've done so much financial engineering with their balance sheet, what do they want to do with capital going forward?
So we acknowledge that it is not ideal to be holding non-voting shares, but we wanted to bring to light that management has done a great job historically. We've seen the successful IPO of CT REIT and the successful acquisition of FGL. In addition to that, the...
Can you define successful? I just want to understand from a return perspective, what does that actually mean?
Yeah, so in terms of the REIT, they were able to bring the transaction to a close in a great way. But Roder, did you want to...
I think with FGL in particular, what we've seen in the last few years is net store closures, yet continued revenue growth. So I think that, we think their new strategy of consolidating store banners, despite net store closures and still being able to grow the top line, is very impressive. And that having a very high growth rate of the company, we view that as like a very successful integration of FGL into the company.
In their credit card business, you had a change in Canadian regulation regarding interchange and allowed returns. Has that impacted that segment of the business here in the last couple quarters, 3 quarters?
I think in 2015 they had the highest return on receivables yet. So I think they've reached 7% return on the gross average accounts receivable. So in their, I think the 10-year average in terms of the return on receivables is hovered around 6%. So in general, I think recently they've shown an increasing profitability in CTFS.
One of your assumptions was that CTC does not pass on the cost increases to the customers. In terms of the sensitivity analysis, how did it look like?
Sure. So approximately 40% of CTC's products, they're sourced from all over the world, and some of them are paid in USD. So 40% are paid in USD. So what we did was, in terms of our cost of goods sold, we split that out into goods that were sourced in Canadian dollars and cost of goods sold that were sourced in US dollars. And for the ones that were sourced in US dollars, while we don't know how much they currently hedge their risk, we just applied 1.4 as the Canadian dollar for 2 and 4 years going forward to sensitize that risk, ultimately arriving at about $19 and $28 in the share price discount.
And in their most recent earnings call, they actually did explain how they do intend on revising, passing down the cost of the depressed Canadian dollar to consumers. It's not something they have done, but it might be something that they're pursuing this quarter and the coming quarters, especially if the Canadian dollar remains depressed in comparison to the US dollar.
If the credit card business is so profitable and where you see a lot of value, why sell 20%? Why not keep it 100% themselves?
I think the partnership with Scotiabank, it was a sign of humility from the management team. They recognized that this partnership was an opportunity to have Scotia advise on balance sheet risk, and this was an important partnership for them.
So you think it would be worth less if it was just owned by themselves and not having Scotia?
No, I think through the transaction, they were really looking for Scotia's help on the balance, excuse me for repeating myself, balance side risk and